hybrid, as you guys probably already know. Here's a Zoom meeting. And for those of you in the classroom, if this, if for some reason you can't make it, these Zoom meetings are, or for you people viewing at home, the Zoom meetings are recorded. The textbook, it should be part of your Laker bundle. Hopefully you can all get into it. If you can't, let me know. We've had a problem in some of my other classes, but hopefully that won't be the case here. I'll move this thing somehow. So it should already be included. I think most of you probably have a Laker bundle. It's just a easy way to do it. Blah, 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 course objectives, blah, blah, blah. Methodology is going to be hybrid format. Now, if you are an international student, okay, I'm not an expert on international visas. So if someone says, do I need to come to class? I don't know. So make sure that there's people you can contact at the school to see if you need to come or not. But needless to say, we're going to have the classes here. I think we missed one class. I think the end of I don't know. Well, here I'll pull it up. Hey, it's not it. We have Thanksgiving break is on 11/26, which is, I don't know what week that is. It's like 6 or 7 or something like that. Anyway, so we will miss one class. That's the moral of that. Gotta do something here real quickly. Okay. I forgot where I was at. Here we go. The assignments are worth 20% of your grade. And those are usually the handouts. We'll have handouts every week pretty much. And then usually 1 or 2 handouts. We'll have a chapter handout, and then we'll have some other things, handouts for statistics and handouts for some other um, uh, assignments and things like that. And then the exams. Now, the exams are emailed unless you're in the classroom. If you're in the classroom, I'll give you the exam. But if you're not in the classroom, the exams are going to be emailed to you. Can you guys see my screen? Yeah, I guess you can. So they're not going to be in the classroom. Let me. It's not going to let me go back, I don't think. Is it? I was going to get into Blackboard, just going to show you guys what I'm talking about. Okay, in Blackboard, we have our assignments, assignments and work, all assignments. And for instance, today's, we have the auditing overview that we're going to do in a few minutes here. And then we have the cash handout we'll start. Basically, you have a week to turn in the stuff. Okay, now in the classroom, I'll just check it in by hand and you guys can go. But if you're at home, you're going to, you can get the handouts here, and you can get the, you can also, let's click on one of these. This is where you submit it if you're at home. Now, if you're at home, you can, there's a few different ways you can submit things. You can either complete it in the Word document itself. That's what I usually do, just because it's easier to read. But anyway, so you can write in the document. You can write it on notebook paper You can take pictures of it. So either way, you can take pictures of it and either scan it or take pictures of it and send it in. And for you guys in the classroom too, if you ever have to miss a class, you're sick or whatever, it's the exact same thing. Now, the things you can't send in, zip files. That's where you combine all you combine all the pictures or whatever into a zip file. Or in Apple, they use what they call page files. They're exactly the same, but Blackboard unfortunately doesn't like those. So you cannot send in zip files or page files. You can send them individually. And let me go back to the assignments here, and I'll show you. Stuff being too helpful. Here we go. All the assignments have unlimited attempts, and that means you can put in as many documents as you want. You can put in 50 documents. So if you have 10 pictures from the handouts, you can just put all 10 pictures in there. Take the highest grade, but they're unlimited. So if like I say, if you're doing it with taking pictures, that's fine. That's absolutely fine. Just to put all 10 pictures in. Any questions on that? Okay, let's go back to the handout or the syllabus. Submitting work. Those of you in the classroom, I can just take it from you in the classroom and you'll be done. But those of you working at home, everything has to go through Blackboard. And usually the assignments are due 1 week after they're assigned. So if we go back to, you guys don't go back, don't go back. Okay. So for instance, the auditing overview, we'll finish that today. That'll be due a week from tomorrow. It'll be due Friday of next week. So you get a week to turn stuff in. This is very important. Late work is accepted without penalty. So if you miss a class or if you miss, turning it in on time or whatever, don't despair, and you still can handle it in with full credit. It just won't be in your grade until you do. So for instance, the auditing overview, if you don't turn it in by next Friday, it'll be in your grade, but until you turn it in, it's going to be a 0. When you turn it in, then obviously it won't be a 0, it'll be whatever you get on it. So you can turn it all the way up until the last day of the course, which I think is the 22nd. No. 14th. Oh, good thing okay, 14th. It's earlier this year. All right. Blah blah blah. As far as the class goes, these are approximate. We'll see what we get through. This first week I put off the classical sampling. I just want to get started on the cash handout, but classical sampling we'll put that off. But anyway, these are basically kind of how we're going to go through. Now, if you notice that there's 2 different weeks, that's because we're on the second half. So this is week 1 of this course, but it's actually week 9 of the semester. I don't know if that matters to anybody. Any questions? And we will not have the exam this week, and we'll probably have it either next week or even the week out further. I have to put it in this format for them to approve it, even though some of these are going to stretch for more than 1 class. So anyway, any question on that? If you want to know what's due, if you go to all the assignments, it'll say what's due and when they're due. So don't worry too much about the handout or the syllabus. Worry about this is more along the lines. Questions? Okay, now you guys are all sleeping. Let's go into auditing overview. And this, I kind of set this up. This is for, I know you've already had auditing, but this is kind of going over a little bit more of the background of auditing, just kind of catch us back up and what is going on with it. Basically, the first auditing class we have, the undergrad, and probably if you had an undergrad class that's auditing, you went over more of the sort of the general looking at the auditing standards and things like that. This class is going to be more focused on doing the actual audit steps. What do we actually do to audit cash, inventory, accounts receivable, all those things. So this is going to be a little bit different, and it's going to be more kind of hands-on. Okay, and kind of going back to what do auditors do? Okay. CPA firms refer to the business that they're auditing as clients. So if they say they have a client, that means they're auditing their financial statements. The clients need the financial statements, and here's why. The clients make their own financial statements, and these are the financial statements you guys have all been familiar with, I'm sure. Now, they make their own statements. So this leads to a problem. And that is, how do you know they're not making things up, making up numbers, cooking the books? And that's where the CPA firms come in. So a financial audit, the financial statements, is to ascertain that there's reliable information, and public companies must have it, but other companies will sometimes need it for bank loans and things like that. But they lack credibility, and that's where the auditors come in. CPA exam. I'm going to bring on something later on about the CPA exam and what it is and all that. But the CPA exam is a license. By a state. It's just like a driver's license. You know, for a driver's license, what do? You get you take a written test, right? And then they bring out on the road and say, let's see how you drive, and then you get a driver's license. It's the same thing for CPAs. You take the CPA exam, you pass that, then they say, okay, we're going to do a road test. The road test is basically 2 years of experience, and when you're done with that, they give you the license. So it's just like a driver's license, and it's issued by the state. The state issues it, only the state can take it away. So you get a license. If you do it in Illinois, it'll be an Illinois CPA license. If you want to transfer it somewhere, you can. Now it's very easy to transfer it. It used to be almost impossible in some states to transfer a CPA license, but nowadays you can do it anywhere. You'll just say that if you want to practice in Idaho, you can take your CPA license from Illinois and transfer the information over and you get a license in Idaho. You can be licensed in 2 states. There's a problem with that though, and the problem is, say, well, why don't I just get licensed in all the states? They charge, it's like $30 a year or something. I don't know what it is now. Maybe it's a little higher than that. Maybe like $100 a year for the license. So if you get in 5 states, you're probably looking at a couple $1,000s of licensing. So but you can get it transferred to Idaho. Your license, give up your license in Illinois, get your license in Idaho. You want to go back to Illinois, you can simply transfer it back. So it is sort of portable. You can take it to any state. Okay, so what do CPAs do? What does a license allow them to do? Only CPAs can do financial audits. We're the only ones that can do it. No one else can. I can't practice medicine. I don't have a medical license. I can't practice law. I don't have a law license. But a CPA license allows you to do financial audits. That's all it does. There's nothing else to it than doing financial audits. So we're the only ones that can do a financial audit. When you become a CPA, you'll be the only ones that can do it. When we do an audit, we will give an audit report, and that audit report will have an opinion. And this opinion is very important because this is what people rely on to know if they can trust the financial statements. This whole course is about gathering evidence to support your opinion. How do you get enough evidence to say these financial statements are free of material misstatement? Do you do that by gathering evidence? It's reasonable assurance. It's not absolute assurance. Reasonable. We don't look at everything. And we don't look at everything for a number of reasons. First of all, you can do statistics and get very close to knowing everything. You can get on statistics, you can get 99% sure. A lot of times taking a very small portion of the whole thing. But there are some companies that'd be impossible. You try to audit the inventory for Walmart. It'd be impossible. There's not enough auditors in the world. There's not enough people to count it in the world to do it all at one time at the end of the year. So there's some things that you simply cannot do, and you must rely on statistics to fill it in. And whenever you do use statistics, it's not 100% assurance. We never say that it's 100% accurate. We say there's a reasonable assurance about whether it's free of, again, only material misstatements. We only look for things that are material. So let me ask you a question. Is $5 million material? Is that a material misstatement? What does it depend?
It depends on the company,
Yeah.
wouldn't it?
Exactly. Depends on the company. If you're auditing Walmart, no way. You're not even
Yeah.
going to look for a $5 million misstatement. It's not. It wouldn't make any
Yeah.
on the. They probably work in billions, and it wouldn't shift it. So it depends on the size of the company. A smaller company, $5 million is absolute, or whatever, is absolutely material. The larger it gets. So material is a judgment, and we're going to find out that this is almost all of auditing is really a judgment. What am I doing here? Can you spell judgment? I'll soon find out. Spell check. How do you spell it?
Judgement.
Yeah.
Yep.
My wife was an English professor, and I get spelled that a lot. Anyway, so this is yeah, but it's all judgment. It's all, what you and that's why it's hard to learn auditing to some extent, because it is judgment. $5 million isn't material to Walmart. Okay, well, what is? That's the next question. Okay, if that's not material, what is material? So yeah, it can be difficult to know what a material mistake is. Okay, let's do some questions. Certified public accountants performing financial audits are responsible for creating their clients' financial statements.
False.
False.
They make their own statements, and we take a look at those. And
We review them.
and to not to put too fine of a point on it, but one of the reasons why we do it is that you say, well, why don't you just go in there and change it and make it, and correct their financial statements? Well, then we have to be independent. And if we were able to go in there and change it to what we wanted it to be, no longer are we independent. Now we are auditing our own work. So we do not change the financial statements, even if they're misstated. We ask them to change them. If we find something wrong, say, oh, maybe you should change it up there. Okay. So first one is false. Certified public accountants performing financial audits are responsible for absolute assurance. Nope.
False.
Yep. We look for. We'll go back to it. Reasonable assurance. I didn't highlight the assurance. Let me highlight the assurance there. We give reasonable assurance. We do not give absolute assurance. Public accountants performing audits are responsible for providing their clients with accurate financial information.
True.
Actually, false. We don't provide them. They have to provide us with the information we need to do the audit. Again, we need to be independent, so we don't give them the information. They give us to it, and we evaluate it. So we don't give any financial information to them. Now, that's not 100% true. If we find something that's in error, we'll tell them about it. So when it comes to errors, that would be true, that we tell them about if there's a material misstatement, for example. But we don't provide them with any financial information other than corrections. Financial accountants performing financial audits are required to help their clients make managerial decisions. False. Good. We do not make managerial decisions. We are prohibited from making managerial decisions. This is prohibited by everybody. We cannot make managerial decisions. Generally you don't, it does come up sometimes, especially when you're making corrections. For instance, one of the things we talk about is internal controls. And sometimes you say, look, these internal controls are bad and you want them to come up with a solution for it, but sometimes they, well, what do we do? That's a normal question. Okay, well, what should we do? You say our internal controls aren't adequate. What do we do with that? And what you can do is kind of forward information to them and focus on what, what are the normal controls and stuff like that. But we don't make managerial decisions for them. And, we don't, and when we do our audit, we simply look at the financial statements to see if they are free of material misstatements. We do not look at them and say that they're a good investment. We don't say that the companies run well. They might be run sloppily. But we're looking at the financial statements. If the financial statements are okay, we sign it. And maybe they have 3 people doing something that 1 person could do. But, that's a management area. Certified public accountants performing financial audits may invest in their client's stock. False. Good.
Well,
False.
They no longer be independent. If I own IBM stock, I don't want to give IBM a bad report because my stock will, so that'll be independent. So we have to be independent of our clients. And this is both in I don't know how to do this. In appearance and in fact. Let me put that in. So we have to be independent in both in appearance and in fact. So let's say I own IBM stock and I'm one of these people that, hey, I own stock in this place. I want these financial statements to be correct. And I'm, so maybe I have an independent mindset that I want to make sure that this is, we do a good audit and we do it. Simply me owning the stock though has the appearance of being biased or not being independent. So it has to be both independent in appearance and in fact. Okay. A CPA firm's financial audit report, I changed the wording on this one, will provide credibility to the client's financial statements. Yes, good, true. People can't trust the financial statements if they just come from, they're kind of reporting on themselves. The one thing that we provide is credibility. That's why we have to be independent. And by the way, this is something very unique to auditing, this independence. We get a license. For example, let me go back up here. We get this license from the state, okay, that we can do financial audits. We have to be independent from who we do it. So, you're a CPA and your brother runs a photography studio, and while your brother wants you, hey, can you do my audit? No. We're related. I can't do it. I'm not independent. And that's very different. If you're a doctor and you have a doctor's license and your brother comes to you and says, hey, I'm sick, can you help me? You go, well, no, we're not, I have to be independent. We're like one of the only professions that has that, where you have to be independent of your client. So it's one of the very unique things about our license compared to other ones is that, if you have someone in your family that's a lawyer, yeah, they can do law work for you. We can't do that as auditors. Excuse me. 7, CPA firms require audit clients to make all the necessary evidence available during the audit. Yep. If there's something that we need to see, they have to turn it over. And you may have a client that doesn't understand that. Maybe they say, well, I'm not going to give you my taxes. We have to. I'm sorry?
Can you dismiss it if they can't provide evidence, or do you still have to consider it?
If they won't give you the evidence, actually we'll get into that down here, next page. But yeah, what happens if they say no, I'm not going to give you the information? Hey, we need to get your taxes for the business, and they say no, I'm not going to give you those. What do you do? But yeah, it basically either way you withdraw from the audit, or you give them what they call a disclaimer opinion, which we're going to go into next. I know what's wrong with this. Let's see my thing here. Okay, certified accountants performing financial audit required to take all clients.
No,
Nope, we don't take all clients. First of all, we might not be independent to the clients. And second of all, we do not take people of ill repute. And this goes back to credibility. You do not just take any client. You know, if they go into McDonald's and they want a hamburger and they don't care your background, they just give you a hamburger. For CPAs, you have to do background checks and so forth. And you are looking for clients that don't have ill repute, because if you sign off on them, not only will it, it'll hurt you in your profession, but all your other clients now will have your name on their reports that you are, associating with people that you shouldn't be. So we do not take all clients.
even if they provide evidence, or that's not,
That's right.
like, even if they provide evidence, you can just take them, or?
Not if they have problems of, if they cannot be trusted, basically. They are, and then by the way, the AICPA is really adamant about them. You take the CPA exam, the integrity of your client is huge. If your client lacks integrity, they say you cannot take them, even if they provide all the evidence that you need. Which the following organizations can license certified public accountants? Good. Yeah, I don't think I didn't talk about that.
Okay,
Actually, the State Board of Accountancy are the only one. The state boards are the ones that'll do it. The AICPA, these people make the CPA exam. I don't know if I have that in there or not. These are the ones that make the CPA exam, and every state uses it. But they don't do the license. But Illinois could wake up tomorrow and say, look, we're not going to make our own CPA licensing exam. We're not going to use the AICPAs, and they could do it. But I don't think anyone's ever going to do that. But they could. So the AICPA makes the CPA exam. And the exams used by every state. The AICPA is just a club. When you pass a CPA exam, they send you a little letter that says, hey, want to join our club? If you do, it's $300, and you send it in, and you're part of the club. But anyway, so the AICPA is just a club, but they do a lot of stuff, and one of the things they do is make the CPA exam. And every state uses it. The state boards, though, this will be like Illinois, Wisconsin. You get the idea. So every state will have their licensing board, and if you pass it in one state, you can usually transfer. You can always transfer. Oh, you can always transfer it to a different state. They will. Sometimes they have a few things. They may have a ethics test or something that you need to take, or whatever it is. But you can definitely transfer it from state to state. If you think about it, the CPA exam is the same in every state. So, okay. Types of clients. We actually have two sets of rules. Non-issuers. They are privately held companies. They go by state laws. And they must follow the state laws and the AICPA rules. Oftentimes, the AICPA rules will become state laws. AICPA will make a rule up, and the states will say, hey, that's a good idea. We'll make that into a law. So a lot of times, these AICPA rules mirror the laws in the state. Not because the AICPA makes laws. They don't. They're a club. They're like the Boy Scouts, or Girl Scouts, or Are those combined now? I don't even know. But anyway, issuers. These are publicly traded companies. They must also follow the same laws and the state laws and all that, but they also have these other two groups that they have to appease, and they're the same group, basically, the Securities and Exchange Commission and The PCAOB, which is a Public Company Accounting Oversight Board. I wish they came up with a better name for that, but that's what it's called. Public Company Accounting Oversight Board. These are federal companies and they're federal organizations. These are the most powerful people in accounting for publicly traded companies. It's kind of funny, IBM, they absolutely have to do whatever the PCAOB and the SEC says. Joe's hot dog stand, the SEC has no jurisdiction over it. Joe's hot dog stand, however they do their accounting, the SEC has no powers over them. They can do whatever they want. Okay, types of audit opinions. Okay, good. Types of audit opinions. There are 4 types of opinions. Actually, there's 3 types of opinions and one. We'll get to that. The unmodified opinion. It's called unmodified for the AICPA. The PCAOB, they called it an unqualified opinion. Basically, these are a clean audit. And this is what most companies get, and I'll explain why in a second here. By the way, unmodified just means that there's no modification needed. Unqualified, you say, well, that sounds terrible. It's an unqualified opinion. It's unqualified in that there's no qualifications on it. You're not going to say everything's okay except for, and then say something that's qualified. That would be a qualification of it. So when they call it unqualified, it means that there's no reservations on it, basically. Okay. This is when the financial statements are deemed to be free. Oops. Of material misstatements. We give reasonable assurance on that, but they're free of material misstatements. In other words, they are fairly presented. And again, we never say that they're accurate or anything like that, but as long as they are not materially misstated, they get an unqualified report. I don't have the opinions on here, I don't think. Let me check and make sure. Okay, I don't. Another weird thing about auditing is all these opinions that are here, these are set by the AICPA and the state. You know how we always say, don't plagiarize anything, don't plagiarize anything, don't plagiarize anything. For auditing, you have to, or you lose your license. The state will say, here's the format for the audit report. You have to follow. If you don't follow this, you can lose your license. So we require you to plagiarize, your work. And if you look at the audit reports for one company and another company, they all have the same wording, and you say, what a coincidence. It's not a coincidence, they have to. Okay, so this is if everything's okay. Free material misstatement, fairly presented. The second best opinion you can get is a qualified opinion. This is called a modified qualified opinion by the AICPA. It's just called a qualified opinion by PCAOB. And that is when there is a material misstatement exists, but it is not pervasive. Oh, pervasive is with an E. Nope. There we go. Let me highlight that. And usually this is when it only affects 1 or 2 accounts. So for instance, let's say that you couldn't verify some of the inventory. Whatever reason, maybe the inventory is in a country that is, they're going through troubles now, or whatever it is. You go through, it's for some reason, you can't verify some of the inventory. Well, you can say, okay, so the inventory account could be off, and it could be material. However, if you look at the cash is okay. The accounts receivable are okay. The equipment is okay. The loans are okay. The accounts payable, everything else is okay. The revenues, the expenses, all that kind of stuff is okay. We just don't know. So it's when everything else is okay, but usually, there's a problem with one account, or possibly two. They get modified or qualified. This is often called an except for opinion because they say everything is okay, and they tell you the bad stuff, except for we couldn't verify, $2 million of inventory or whatever it is. So if you hear someone talk about an except for opinion, it's a qualified. And these are kind of like the second best because, yeah, that should be green. Hold on a second. My coloring is off. Oh, I got a handout for you guys about color coordinating. This is for remembering things. Believe it or not, it's hard to see. It's more difficult for us to see colors than it is to see black and white. Use a bunch of brain power. And the idea is that the more brain power you use for any of these things, your brain says, okay, that must be important because I'm using a lot of brain power and it remembers it. Your brain will remember colors more than black and white. That's what you see advertising, they all have all the big colors and splashing and all this that's part of it. You remember it. Okay. So modified is an except for. So there's a material misstatement, but it usually is confined to one account or two possibly, but the rest of the financial statements are okay. You can rely on, cash, revenues, all that stuff. Okay, the worst opinion you can get is this one. Adverse opinion. The adverse opinion is when they are materially misstated and pervasive. This is to say that the financial statements are not GAAP, not generally accepted accounting principles, not fairly presented, cannot be relied upon. Okay. Now, here's the thing about the B and C that is that is part of the audit report. We will give the dollar amounts of the misstatements. So, and I'm going to put it underneath here. So for example, we'll say that, inventory is misstated by, oops. Nope. So we will put it right in the audit report, what these things are misstated by for these, the modified qualified and the modified, adverse. So there's gonna be more than one usually, the inventory, revenues, and, expenses. But we would do all these separately, or. Whatever it is, $50 million. We would do these individually, but the idea is exactly the same. We tell exactly what they are misstated by. Notice that it's going to be in the report anyways. So for these, you're going to try to get them to, you want them to put out you want them to correct the financial statements, right? You want them to correct the financial statements. So what you want to do is hopefully tell them, look, this is misstated by $50 million. They say, well, wait, I don't want to change it. It's going to be in the report anyways. People are going to read it in the report. And once they read it in the report, they're going to, realize that you're trying to create a fraud here. So it's really your best interest that you change it. So truthfully, qualified opinions and especially adverse opinions are very rare because they're not going to be able to hide that. It doesn't say, well, no, we're not going to change it. We're just going to put it out and hope no. No, the audit report that goes with it's going to say it's misstated by however much. So, and again, the idea for these, part of the idea for these is to say, look, it's in your best interest to change your report. Scratch it, change your financial statements. So we want them to correct the financial statements. Okay. Now, the last one here, it's a disclaimer of opinion. They count this as an opinion. It actually is not an opinion. It's called a modified disclaimer or discount. If you notice that the ACCT, they say it's modified. Everything has a modified in front of it. But this is when there is not enough evidence are unable to gather enough evidence to form an opinion. The auditors are unable to get enough evidence to form an opinion. This is when you get a disclaimer. It's often just called a disclaimer, but it's actually a disclaimer of an opinion, and it actually is no opinion. And they generally don't have, what am I doing here? The dollar amounts are usually not given unless they're saying something along the lines of we couldn't verify $10 million of sales, $10 million, whatever. But it doesn't say it's misstated. We don't know if it's misstated. There's not enough information. So we can't say that they're misstated. If we know that they're misstated by a certain amount, we'll put it in there and it'll be either a qualified or an adverse opinion, but we don't know if it's misstated or not. Not enough evidence. This can also be true. A friend who did an audit and it kind of he didn't know this when he took the audit on, but the guy did a lot of his transactions in cash. Like the bulk of his transactions were in cash. He had no idea, and it was a construction company, and he couldn't verify a lot of the stuff. So he got a disclaimer, like, you're doing it in cash, and there's no receipts or anything, and it's, it was just there wasn't enough information. So anyway, it's when you can't get enough information to do it. Now, suppose someone's getting an adverse opinion. They say, "Don't give us an adverse opinion. Give us a disclaimer." Can you do that? So you find their financial statements, they're materially misstated, it's pervasive. Can you give them a disclaimer instead?
Oven has to pre-
No.
The oven has to preheat.
No,
I'll get all this
No.
stuff ready, okay?
You can't.
No, because there's already information there
exactly.
versus no information.
What princess?
Exactly. You have the information that it is misstated. And this one says you don't know. You do know. So if you're getting a adverse opinion, you know that it's off misstated by a certain amount. You know, just come down here to issue this would be sort of like a fraud on the auditor's part because it says you don't know if it's misstated or not when actually you do. So this you can't trade one opinion for the other. This is for an adverse opinion, you know that it's misstated. For a disclaimer, you really don't know. There's not enough information. Okay, let's see. Are these on the same page? I don't. Okay. We'll go through these and we'll take a break. The auditors determined that cash, inventory, and revenues were all materially misstated. What audit report would be the most appropriate for this scenario?
Adverse.
Yeah, probably, because it's for multiple, looks like multiple accounts. We probably do the adverse opinion. It's possible that it would be qualified, but
Look at how it got caught. We found the fridge and got caught.
Oh shit, that's fine.
Yeah.
Oh, sorry, my bad. I forgot to mute it.
all right. So it'd probably be a modified adverse opinion because it's more than one account and even more than two, and the accounts that are misstated are kind of heavy. They're cash, revenues. Those are two big ones that you're gonna promote. So probably it could be a qualified though. It depends really on how badly it affects the rest of the accounts. Okay, number 11, the auditors determined that cash, inventory, and revenues were all immaterially misstated. Which one? Hmm.
You don't have another big puppy?
Modified qualified.
B.
Actually, it'd be A.
Oh well.
Yeah, not material. So if they're and by the way, especially larger companies, they're always going to be misstated by something. Almost always, it'd be very rare to have say inventory at Walmart be 100% correct or whatever. So they are going to be there's going to be immaterially misstated. But if nothing is material, we give them a clean report. And again, we don't say whether it is we don't put in things that are immaterial into the report. I'll give you an example. I found when I was doing an internal audit. I was an internal auditor for Navistar. We have an insurance company, and in an insurance company, I found a $100,000 cash error in our financial statements. I took it to the external auditors. The guy just shrugged, whatever. Because the company had like there's 230 million in assets or whatever, and $100,000 was not material. But so this materiality is very important. That if it's not material, we give them a clean report. Okay, the auditors were unable to verify a material amount of offsite inventory on the client's books. None of the other accounts were materially misstated. This one could actually be one of two different ones. So we couldn't verify a material amount of inventory, and none of the other accounts have a problem.
Probably B or D. Like
Yep.
B, but it could be D because you can't verify the material amount.
Yep, very good. And it could be B or D. If you deemed it that it would be enough to question other parts of the of the audit, you could give them a disclaimer. You could also say, look, there's something material here and we can't figure it out, and give them a disclaimer. You might want to give them a modified report. And it goes back to this, a disclaimer, this is like getting nothing. A disclaimer is sort of like getting nothing. Here's your client, they're paying you money, and the report says nothing. Okay, here's your disclaimer. We were shrugging our shoulders and saying, I don't know. Whereas this qualified report is really sort of like the second best thing you can get. Say, okay, look, we can't figure out the inventory, but the rest of this looks fine. Cash is okay, accounts receivables are okay, whatever it is. So the qualified sort of like the next. So if you can give them a qualified, you'll try to give them. This will be the first try here. I'll say the first. You'll first try to give them this. If you really feel like you can't give them that, then you'll probably go to this one. And again, you want to give as honest of a opinion as you can. And again, if it's just one account, and if you don't think there's a problem with the rest of the financial statements, or that it's material, but it's a small enough amount that you can rely on the other stuff, then you probably just go with a modified qualified report. So the qualified report is good for situations like this, where there's only one account. And again, this is maybe something that the client can't control. For whatever reason, they can't get to their inventory. Okay. 13, the client refused to allow the auditors to contact the client's lawyer. Which audit report would be most appropriate in this scenario?
Would that affect the audit?
Well, yeah. Well, that's another good question. In the United States, yes. And when I say that United States, this is something that is only basically for the United States. Other countries don't have our crazy law system. Other countries, they don't have people stubbing their toe and getting millions or whatever. So in the United States, contacting a lawyer is required. You must contact as part of the audit, you must contact their lawyer, their legal counsel. So, and if you can't do it, in the United States, if you can't do it, it also raises the question of why can't I talk to your lawyer, right? I mean, it's sort of like murder, and they say, okay, you can look anywhere you want, but don't look in this room. Well, you want to look. That's the first place you want to look, because it said I couldn't look in there. So this one, if they don't allow you to contact the lawyer, and this is under the control of the client now, the client is refusing, you're probably going to give them a disclaimer, because you don't know. Now it raises the question of what would the lawyer tell me that would give good reason for the client not to want me to contact them. And this is another thing too, sometimes in the way that you talk to the client before you take the audit, let them know we're going to talk to your lawyer, we're going to, we got to look at your taxes, we got to look at everything, so that they know right up front that this is going to happen. So again, and this is because it's unknown. How big is it? You don't know. Could be nothing, could be millions of dollars. Okay, why are qualified and diverse opinions rare?
Okay.
Maybe not A. Which one?
Including the student.
About B.
Yeah. There's no real advantage to them doing it, to not changing their financial statements, because the amounts are going to be included in the audit report anyways. So they're not doing, and basically it's just going to make them look worse if they don't change the financial statements. So it's going to be that the amounts are going to be included. So they are rare, and you hope as an auditor that they will change it. Okay, let's go ahead and take a break. I'm going to pull up the next handout we're going to look at, this cash, and let me see, what time is it? we'll say be back at what? Oh, yeah, good, 7:10. Okay, well, we'll go ahead and take a break and we'll come back and we'll start in on the cat. Oh, yeah, no, I'll wait until we come back. All right, let's go ahead and take a break. Okay, let me see here. Sure everything's working here. Okay, for those of you, yeah, I'm frozen. For those of you working at home, let's see. So what you're going to do is, however you did the auditing overview, click on the auditing overview, and you're going to submit it. Usually you just do upload files. You can also do create if you want, but upload the file to it, whether it's pictures or the handout itself, or however you did it, if pictures of notebook paper, whatever it is. If you go ahead and just take pictures of it and submit it. And again, it's unlimited, the number of pictures you can put in or documents. Okay. So so this will be due, well, it's actually due a week from Friday, a week from tomorrow. All right, let's go to cash. So we're going to start with cash, but first I want to talk a little bit about how we do an audit just in general. And we basically have 5 types of accounts. We have revenues and expenses, we have assets, liabilities, and equity. It's actually kind of amazing that, the most complex transactions you can think of will fit into those 5 different areas. Now, revenues, I also mean like gains and expenses, losses, and things like that. But, money coming in, money going out, assets, liabilities, and equity. So these are basically the 5 types of accounts that we use. And again, it is kind of it's a clever system. Okay, so which one of those categories, those 5, would be the easiest to prove? There's one that's more obvious than the other ones.
Revenues?
Close. Assets. For instance, the building, inventory, all those things, you can actually go look at those. If you look at, let's say you go to a Target store, what are you actually seeing? Well, you're seeing the store itself, you're seeing their inventory. You can actually see a lot of their assets. Now, you can't see their liabilities. You don't know what their liabilities are. You don't know what their equity is. Revenues, you can kind of see those coming in, but to get a dollar amount would be more difficult. But the assets are the easiest ones to prove. So we start with our assets. Next thing we move to are the liabilities. Now, if the assets are okay and the liabilities are okay, what does that tell you about the equity?
It should be fine because liabilities and equity should equal assets, right?
Yep, exactly. So if we get the assets correct and we get the liability, not correct, I shouldn't say correct. We get comfortable but they're not materially misstated. They won't be perfect, but they don't need to be perfect. If the assets and liabilities are not materially misstated, then the equity is. And notice our revenues minus our expenses, that goes into our income. The income goes into the equity. So at least the net income is probably okay too, because the net income will show up in the equity. And if the equity is not misstated, then the net income probably isn't either. So we start with our assets, we go to our liabilities. We really beat up the balance sheet when it comes to auditing. The balance sheet is what we focus on. And again, it's easier. And it kind of ties the rest of the stuff in. And we'll see how that, we'll see more of that down here. Okay, the audit of cash. Oh, wait, what happened here? Okay. Like the cash account may be immaterial in amount, but the impact on the financial statements. I'll clean this up in a second. Is sort of exaggerated. I shouldn't say exaggerated. It sounds like it's fake. Profound. So the dollar amount might be immaterial. The cash compared to inventory, compared to buildings and all that stuff might be immaterial. But almost everything goes in to cash at some point. It's almost hard to think of a transaction that doesn't. If you sell something, they might give you cash for it. That's a cash. If you sell to them on account, eventually that accounts receivable will be collected. That'll be cash. You buy equipment you buy with cash. Oh, I get a loan. Okay, you're going to pay off the loan. What are you going to pay off the loan with cash? It's almost difficult to find a transaction that doesn't have to do with cash. The only thing I can think of is something like if you trade stock for land or something like that. You have to really get creative to get cash out of the equation. So cash is a very important account, even though it might be immaterial on the financial statements, a very small amount, but it carries a larger impact. Often it can be audited 100%. You can get bank statements. Okay, they have 10 bank statements. Okay, you can get 10 bank statements. That's not a problem. 1,000 bank statements, you can get 1,000 bank statements. So we oftentimes don't give very much leeway in cash. We say, okay, it's got to be pretty much there for us. So the auto cash, even though it's an immaterial amount, it affects many of the other accounts, and often it can be audited to the 100% level. Another thing about cash that's different than other accounts is so desirable. There we go. Cash is desirable for embezzlement. That embezzling cash is it's a very it's universally useful to people. I worked at Navistar and we built trucks, and I don't think anyone's ever stolen a truck from Navistar. It'd be hard to conceal that, first of all. And what are you gonna do with it after you steal it? You got a truck that you need to sell to somebody and whatever. It could have happened. Yeah, it could have happened, but much more likely that someone, if they're going to get money out of Navistar, is going to look for the cash to get the cash out. They don't want to get a big truck that they have to, somehow get rid of. So it's universally desired by people to steal cash. So it's a vulnerable asset in that way. Okay, let's go down to here and kind of see how this stuff all takes place, though. So here's our cash. And this cash account is, what we're looking at, and kind of just going through here, shapes. So if we sell something for cash, I gotta do something. I don't know why the default is light blue, which is basically invisible. Okay, so if we sell something for cash, it'll go into, right from the revenue, it'll be revenue, and there'll be cash on the other side. That'll be the journal entry. You say, well, what about if it goes, what if we sell it on account? Okay, it goes to accounts receivable. And from accounts receivable, we collect the cash. So that'll end up being cash too. So we can basically prove the revenue account through cash. Inventory, if we buy inventory, oh, wait a minute. If we pay cash for it, it'll be right in cash. We can prove out the inventory that way. But we say, okay, what if we buy it on account? Okay. Yeah, how come I went all the way over there? What are you doing? Isn't this fun watching me learn how to use a computer? All right. Inventory, if it goes to account, we buy it on a credit. And what do we pay off the accounts payable with? We pay it off with cash. So we've just proven the inventory account through cash. And again, it's almost hard to find something that doesn't go through cash. Expenses will be accounts payable to cash or just straight to cash. Long-term payables, if you're paying off a long-term loan, it'll go through cash. So while the cash itself might be immaterial, its impact is huge. And auditing cash will often transfer into these other areas, that you can actually prove out just by auditing cash. Question on that? And again, it's almost difficult to find a transaction that wouldn't be cash. Some weird kind of a trade, I guess, would be the only thing I can think of. Stock dividends, or they give you the dividends of stock, that would be, but you can prove out the dividends. What are dividends paid with? Yep, cash. These dividends, okay, that should show up in the cash account. And if you prove out, the expenses and revenues, this income will be proven out, and that will also prove down here. So cash is a very important account, and even though it's immaterial often, it is very much looked at. And also, we can often audit it to the 100% level. So cash is a really important account for our audit. I know it looks like a mess now, but you get the idea. Everything, all roads lead to cash. How about that? Okay. First thing we got to talk about is segregation of duties. These are sometimes called incompatible duties. Don't write it like I just did, because that's wrong. Okay, incompatible duties, sometimes we call that. So segregation of duties. We remember it by, this is for those you taking the CPA exam, CAR. The C is for custody of assets. The A is for authorizations. And the R is for record keeping. So these have to be segregated. They cannot be together. They're also called incompatible. You don't want to have someone have access to two of these. For instance, record keeping. This is usually done by accounting. Now, as someone in accounting, they generally don't let you deal with cash. Why? Because that would be an asset. So, let me just say cash here. This is so this would be the Treasury Department. Oops. And you don't want these, you don't want to give the duties of custody of the cash to the accounting, because if the Treasury Department steals the cash, they have access to the cash, but if they steal it, the accountants should find it. Notice that if these were both under the same, given to the same person, or even if they were two people getting together, it'd be very difficult to find. You can make the cash disappear because you have custody of it, and you could use record keeping to cover it. It'd be very difficult to find if that were to happen. So we keep them completely separate. The two companies that I work for Navistar and US Steel, and I don't know if it's still this way, but both those companies had the Treasury Department in a completely different building. And part of it was, to keep people away from each other, just to make sure. Okay. Question on there. So we try to keep these all separated, these three. And whenever you come across a problem, it's almost always in this area. It's as basic as this, these three: custody, authorization, who can authorize a transaction, and the record keeping of it. And no one should have two of those. Okay, let's go through the basic receipt of cash. Something's wrong here. I don't have enough screen here. Okay, there we go. Okay. Receipt of cash. How do you receive cash? So this is if someone sends you a check. There's a way to make the color of shapes so you can see them. Yeah, what I want to do is they have it automatically do this. So they want to know how to do that. Okay, so someone sends a check. It's going to go to the ABC Corporation, either the mail room or the accounting room. I did this, by the way, when I was in, let me turn the light off. When I was working through college, I worked in a bank, and I was a maintenance guy. But anyway, every day though, we get all these checks in from customers, and we go to the mail room. We had an opening machine with an open mall, and there'd be two of us, and we would both do create a checklist. So it'd be checklist, and we both do them, and we match them up. I didn't know why both of us were doing it, but I realized later. But anyway, so the mail room, or they could also have a accounting room. But the check will go to, let's see, mall room. It should say mail. Okay. Made up a new organization, a mall room. Okay, so it goes to the mailroom or accounting room. And a lot of times you'll have two people or sometimes more counting them. And again, why is that? Why do we have two people? One person could do it. And management people, they'll come and they'll say, why do you have two people doing this? Exactly. What's to keep someone from yeah, it's sort of like this, and it's almost a kind of a statistically. So if let's say that this is a person cutting checks, and let's say there's a 10% chance that this person will steal something. That's actually very high, but let's just whatever. So there's a 10% chance that this person is going to steal something. Okay. Now, if you put two people in the equation, they would both have to have that same. So, your chance of theft goes from 10%, by adding another person goes down to 1%. And actually, it may even go less than that because, even if you both are thinking that you want to take money, you may not say it. So adding more people to it, especially something like this, it's one of those kind of math things that it reduces the likelihood that something bad's going to happen. And it did. I was doing it, and then there was a guy that worked in the mailroom and did deliveries and stuff, and we both do it, and we both match up the checks at the end. So we do these lists. Okay. And let me give myself more room here. We'll put these two lists. Okay, we'll have, so these two lists are made. And the one list goes to accounts receivable. Why do we send it to accounts receivable? One more time. Exactly. So someone sends a check, and for us, it would be at the bank, it was a loan or something usually. But they take their checks and we would apply it to their account and say, okay, you paid off this or you deposited this amount of the account. But in this case, if you get for accounts receivable, they say, okay, what's this? Joe Customer. So Joe Customer, this is Joe Customer's check. And so somewhere in here, we're going to have Joe Customer's accounts receivable be we'll apply this check to his account. So accounts receivable will get the list of the checks. The next ones that will get the checks will be the cashier. Now the cashier will also be given, the checks. So here's a checklist. These are all the checks that we have. Here's the actual checks will also go with the cashier. The cashier will put them in, they have a cash register, they'll put in the cash register, but they'll also collect all the checks and also the cash from the day and whatever. And that will, the cashier will then make a deposit. And let me copy this one actually. Okay, so cashier gets this and the cashier gets the checks. Oops. And they'll make the deposit, put the deposit together, and they'll bring it to the bank. Sorry, this is taking so long. Okay, so cashier gets everything. They get the checks. They collected all the checks. They also had some cash here they put together and they put this into the deposit. And here we have, so here's Joe Customer's check, and it's going to be in this deposit. Now I'm going to make this green. I'll tell you why in a second here. And this will show up on the bank statement, the deposit of $1,038.01. Okay, let's go through a couple things here. Let's say that somebody steals a check somewhere along the line here. So let's go through the scenarios. Someone in the mailroom steals a check. How are they going to find out about that? I'm sorry?
It's not deposited.
Okay, so someone in the mailroom steals a check. And it never, now, first of all, they'd have to be completely stupid to put it on the list because the cashier is going to get the list and the cashier is going to say, where's the check? You know, there's a check for 1, 2, 3, 4, 5. Where is it? And then go back to the mailroom and, So if they didn't put it on the list, though, let's say they just put it in their pocket and went and cashed it somewhere. They're going to find out the customer is going to say, look, it was cashed. And contact accounts receivable, say it's not on any checklist. Then you start looking at where was it cashed, and you go to the 7-Eleven, and you look at their security cameras and you see the mailroom guy cashing a check. Okay, suppose the cashier it takes one of the checks. Well, it's not going to show up on the deposit slip, and it's not going to balance out with the deposits if the cashier takes it. And two, it's on the checklist, so anything on the checklist should also be on the deposit list. So you compare these two, the checklist with the deposit list, and they should all be the same as far as the checks. Okay. Now, one more thing though. Joe customer's check for 1, 2, 3, 4, 5. Is that going to be on the bank statement? Generally not. You're going to see these deposits, and that deposit is going to have, it's going to be in total usually. So the deposit will be shown for the day. They will not show individual checks usually. If you want to trace the individual check, you'll have to go to the checklist to see the individual check. And again, if it's not on the checklist, then someone in the mailroom got it, or maybe got lost in the mail. That's another idea if it was never cashed. But yeah, so notice the individual checks cannot be verified in the bank statement. Only the total amounts of deposits here. Yeah, that's what I said. Here's a question. Why don't we give the checks to the accounts receivable people? Why do we give it to the cashier? We could just give the accounts receivable person. The accounts receivable person can make the deposits. Why would that be a problem?
Because if you give it to AR, can't they also adjust the entry?
Yeah, they could, if you give this check to AR, AR says, okay, Joe customer mail, I'll just write off Joe customer's account, and then I'll take Joe customer's check and put it into my account. So this is why, this is the bookkeeping function. Oh, I can't do it there. Hold on. I think it's called record keeping. I don't know why I'm saying book. Well, it's both for accounting, but so this is a record keeping function, and you don't want them to have custody of the asset also. So you don't want them to have custody of the cash. I should say not. So we're keeping them separated. So you do not give the checks to accounts receivable. Now, someone who may not know what we do. That's not how you spell cash, by the way. You'd think I'd be able to spell that one. All right. So somebody who maybe doesn't know accounting would, or auditing anyways, would say, well, just send the checks to accounts receivable. They'll know what to do with it. You can't do that. The record keeping, they could write off the account and then they could also put the check in their pocket. Okay. An auditor needed to confirm a customer had submitted a check to the client. Which documents would the auditor likely examine? There's actually two of them. Probably not. I mean, it's possible if it was already in there, if it was already included in the, on their account, maybe, yeah, but I'm assuming that this is when there's a problem usually. Where would that check need to be? Yep. Yeah, so these are the two things you're gonna look at. Now, if there's something on the checklist that's not on the deposit slip, you know that the cashier took it. If it's not at either of those, you know, someone in the mailroom probably took it, if the check has been cashed. So, yeah, you can look at these two. If a customer's cash check was missing and did not appear on the checklist, who likely misappropriated? I like that term, misappropriated. It's also much better. Yep. Yeah. If it was cashed, the first person you'd probably look to is whoever was in the accounting room. Now, it's possible it went to some other place and was, you know, mismailed to somebody, but you look at see where the check was actually cashed from. But if they did a check and it was did not appear in the checklist, that's one place you'd look. Okay. Bonding of time. Oh, we're getting late here. What are we doing here? Cutting farther than this on this thing. Oops. Bonding employees. Employees can't spell anything right now. Employees that handle cash are often bonded. The bonding is an insurance policy for the theft of cash. Okay, so all bonding is it's an insurance policy that if somebody steals cash, that the bonding company will reimburse the injured party, the company, the client, for whatever was stolen. So it's just an insurance policy. So bonding employees, does that mean that nothing bad can happen? No, it's like any other insurance, you know, car insurance doesn't guarantee you won't be in a car accident. Same thing. It doesn't mean nothing bad can happen. It just means that you're covered in case it does. Now, the most important thing a bonding company does, they're not idiots, so the bonding company will do background checks. Perform background checks on employees that are bonded. So one of the important things that they do is they'll do a background check. And I had a friend that worked at a place, they hired a guy, and he came in, really good, and knew everything and blah, blah, blah. And he got to the bonding company says, we can't bond that employee. You can hire them. They don't, it's up to you to hire them, but we're not going to bond them. And they found out that the guy had just, he did like 3 years for fraud in the prison. And of course, that was not on his resume. But, part of the reason why you have the bonding company is that they do these background checks and that they will highlight people that maybe you shouldn't be hiring, or at least shouldn't be dealing with cash. Now, if this person stole cash, maybe they have them doing something else, but okay. Question on that? So bonding in place, it's nothing more than insurance. It doesn't mean that your controls are good. It doesn't mean that nothing bad can happen. It doesn't mean that, it's you don't have to worry about cash. It's simply an insurance policy that if something bad does happen, and they usually have limits on it, bonded up to $1 million or whatever it is. But it's just insurance. But the big thing is they do background checks. Lockbox service. Okay, this is when you don't want your employees to actually handle any cash. A lockbox service is customer payments are sent directly to the bank. Bank will count the receipts and send a checklist to the client, whoever your client is. The cash is deposited directly into the account. So instead of having it go to your mailroom, you have them send the payments directly to the bank. And an awful lot of companies do this. They'll go right to the bank. The bank will count the cash coming in. They'll send a checklist to the client saying these are the people that paid and how much they paid and all that. So all the client will get is a checklist. It will be deposited directly into the client's account. They call this a lockbox system. It used to be that you would payments directly to a bank, you'd drop them into a box that was locked. Banks used to only be open from 9 a.m. to 3 p.m. And those are called banker hours. If you watch old movies, they talk about banker hours. They opened at 9 in the morning. They closed at 3. There were no branch banks. There were no ATM machines. If you wanted to deposit cash, you had to take off from work, go to the bank, your bank, deposit the money, and then, or withdraw money between 9 and 3. And one of the things they would have, though, usually is a Dropbox. A Dropbox is for people who want to make payments that when the bank wasn't open, they would kind of like, you bring back a library book. You put it into a slot and it would go into the bank and the bank would count it the next day. I have a bank that still does that. It's in LaGrange. I live in Brookfield, but the bank's in LaGrange, and I don't feel comfortable doing it. But anyway, so okay. So what's the advantage of this? Well, let's go to number 3. Yep. The advantage of this is the client's employees will never have access to the customer's checks. They never touch them. There is no bonding, and you don't even have to bond the employees. They don't have any cash coming in, or the ones that you used to do for the collection of cash. Okay, where are we at? We'll do this one last thing, then we'll stop. Disbursements of cash. how do you get, one way to steal money is to just steal customers' deposits coming in. Another way to steal money, and if you're doing auditing, you sit around all day thinking about, if I want to steal money, how would I do it? Is getting the company to pay money out. You can steal it when it comes in, or you can try to get them to pay something that they don't need to pay. So disbursement of cash, and this could be a vouchers payable. Vouchers payable and accounts payable are the same thing. Vouchers payable, let me go through this and then I'll tell you what the difference is. Very minor, but anyway. Okay, what do we need before we will pay something? We need a purchase order. We need to know that we ordered it. Was the order made? Second thing we must have is a receiving report. We're not going to pay for anything unless we've actually received it. And then lastly, we need the vendor invoice. Oops, that's not it. Oops, that's not it again. We need to have these three things before we'll pay for any, pay it. And by the way, well, let's talk about this for a second. The purchase order. Does the purchase order have to match the receiving report?
Yeah.
Yes, with an asterisk. So let's say we order 100, I don't know, roller skates. Is that one word? I'm gonna leave it as one word. Let's say we order 100 roller skates. Now, ideally, we would get 100 roller skates into the receiving report. Now, the receiving report will not have the dollar amounts. Oops. Well, now that's being underlined. Let's see what does it want me to do? Oh, it's 2 words. Don't. Okay. So let's say we ordered 100 roller skates and they came in at $100. I'm just making these numbers up. No, what are you doing? Did something wrong. For $100 each. The receiving report will just say, okay, we've got 100 roller skates. They don't need to know how much it is. They just want them to count. Well, the receiving report will basically be a purchase order with the quantities blanked out because you want them to count the roller skates. So you get 100 roller skates. And the vendor's invoice should match up for those two. And generally, you want those all to match. It's possible they don't. Why might not they match? Why might the purchase order be different than what the customer or the vendor actually sends? Maybe they don't have 100 roller skates. We don't have 100. We'll send you 80. Oh, what happened here?
Maybe some are on back order.
Yeah, so they put some. I know what it is. My number lock isn't on. Yeah, so this will be 80. Now notice that should change the invoice, right? The invoice shouldn't be for 100. It should be for the 80 that were sent, right? So it isn't. These don't always match up exactly. I've seen in textbooks where they say that they need to match exactly. Oftentimes they won't. The quantities might be different. But certainly like the price should be the same, and what they're ordering should be, they should actually have made the order for them and all that. But these have to be matched up before we will actually pay the invoice. Now, this is a very minor thing. Vouchers payable, they'll match those things up and it will turn those into a vouchers payable, which simply means that it's approved. Accounts payable are not approved until you get these 3 in. So it's sort of like one more step to put in a vouchers payable. It'll go from an accounts payable to a vouchers payable, and the voucher payable will get paid. It's a very minor thing, but they're basically the same thing. And these are the three things you must have for a disbursement of cash. question on it? Let's stop here. By the way, next class we'll be doing something in the for the sampling, just to kind of break it up a little bit. I don't know, too much of this kind of wordy stuff is kind of hard to go through. But anyway, so for purchase orders, scratch that. For vouchers payable, you need to have a purchase order, receiving report, probably were actually received, and that should match with the invoice. And the invoice will not necessarily match with the purchase order because they might not have sent exactly the same thing. Okay, in the classroom, I'll check this off. You guys just hold on to this. We're not going to turn this in yet. But we are going to turn in the overview. So turn in the overview in the classroom. We don't need to do that. I'll just check them in, but can't get back to my, oh, there we go. So we'll stop here. Let me see. Well, here, any questions? Let me talk to people. Any questions at the Zoom people, the Zoomies? We'll call you the Zoomies.
No, thank you. No, I ain't got no questions, Professor.
Okay,
I did have a
No
quick
question,
one though.
Professor.
sure.
I just had a quick one about like what you said earlier about when you have like your CPA license in Illinois and then you can go to a different state and you give your Illinois one and then you get a different one. Is there any at any point where you would have multiple, like one from Illinois, maybe one in Wisconsin, or do you have to give it up?
No, you don't have to give it up. You could have it in all 50 states. And if you did, let's say you had clients that were in both states and you worked with them all the time, you might keep 2 licenses. You know, it just makes things,
Okay.
You could definitely do it. It's not that much money. It's about $100 a year, I think, something like that, 90 or $100, something like that. So it might be worth it if you had clients in both states. Yeah, you could definitely do
Yeah, I
it.
wasn't sure if like it was like mandatory, like if you went to a different state, you had to turn in your old one, or vice versa. Okay.
No, and you just like a driver's license, so you can have a driver's license in more than one state. So yeah.
Okay.
I was gonna say isn't there also a thing where you can take a CPA exam in a different state instead of your own home state, or no?
You can, if you can, you gotta get licensed in that state. I don't think you can actually switch from one state to the other because it's gonna be the facility is gonna be a different. I'm not sure on that one, to be honest with you. It's possible, the more you think about it, because they do the testing in the Prometheus testing sites.
Well, I only asked because my colleague from my old job when I was working as a tax accountant, he's from Korea and he was working in he's working in this state, but he said I'm probably gonna do my exam under Indiana because he supposedly said it was easier.
The more it's the exact same exam, but it could be that where he is closer to his house or something like that. That would be fine too. The more I think about it, you might be right that because it is their national Prometheus sites that they give it at, so it might not matter where you take it. It's the exact same exam.
Yeah, that's what I thought. That's what I assumed. I was like, I don't see why they would give a different one depending on the state.
No, it's exactly the same exam as given by the ACCT433. Now, some states may have different requirements. Sometimes it will make you take a certain ethics test. There is one given by the ACCT433 that usually they use, but there could be other things that the different states will have, but the test itself will transfer from one state to another. Yep. Okay, any other questions? I will wave goodbye to our friends at home.
Yes, I came late today. I don't know if
Have a good one.
Yeah, I'm going, everybody.
Okay.
Have a good night.
Good night.
yes.
Night.
Good night.
Good night.